Hey everybody, we got a special edition today. Usually I'm the one interviewed, the one who gives the quotes. Today, however, I'm the interviewer, and my special guest is Bob Powell. He's the editor of Retirement Daily, which is part of TheStreet.com. You can see his articles on USA Today, among many other places in the media. He's been good enough to support me and maximize your Medicare since the beginning. Here's our conversation. We covered a range of topics, not only about himself, but we've also talked about GameStop, of course. We're almost obligated to. And since he's from Massachusetts, we talk about my man, Tom Brady. Hope you enjoy. So today's something new and different. I'm turning the tables, not completely upside down, certainly, but at least turning them around a little bit. I'm usually the interviewer, and my distinguished guest is Bob Powell, who is a very experienced, highly acclaimed, retirement editor, journalist, long list. Bob, I looked at your LinkedIn profile. It's too long to read here, but let's just call it for the moment your current roles. You're the editor of Retirement Daily, which is part of TheStreet.com. Amongst many other things, your writings, USA Today and many other locations. Thank you so much for, including me in your effort. Thank you and welcome to the podcast.
Yeah, Jay, it's a pleasure to be here with you and have the tables turned.
That's right. So I'm calling you where? You're in Massachusetts, is that right?
I'm in Massachusetts, about 10 miles north of Boston. Yeah.
And that's where you've been for this whole time, or for the majority of your adult life?
My wife and I moved here in the early, we've been here. We're interlopers, quite frankly, but we moved here in the early 1990s, 1991. Yeah.
So does that mean that let me ask you, since you're in Massachusetts, I got to ask. So are you in the camp of you want to see the Tampa Bay Buccaneers win? Or you're in the camp of, well, this is all Belichick's, doing, so, screw you, Tom?
So that's a really tough question, right? It's hard to live in New England and not be a Patriots fan, not support Tom Brady, not support Belichick through right and wrong.
Right.
But I'm in a pool, and the odds of winning if I bet on Brady are against me. So I have to bet on Kansas City in the pool, but I may be rooting for Tom. So I have mixed emotions, Jay. It's a really tough question because I think, when he left the Patriots, he left a team where he didn't have the weapons to do what he wanted to do.
Oh, clear. Very clear.
So I partly blame Belichick for that, and kudos to Brady for landing in a spot where he had all the things that he wanted: wide receivers, tight ends, blocking, running backs. I mean, it was a great coach and great coaching. So kudos to him.
Well, I'm clearly the bias, right? Because he went to the University of Michigan. So I've known, about Tom Brady since he couldn't get on the field, even in Ann Arbor. That, he was the backup to Drew Henson, who was supposed to be, the cat's meow. Yeah. And so he's been fighting uphill this entire time, that and of course the famous, 5th or 6th round draft pick and the whole thing. So always had this, very large chip on his shoulder. I think though that he might be over it.
I think he's over it, and now there's something else that he's striving for, I think, which is, to never be challenged as the greatest of all time, right?
I think it's already over. I mean, the candid. I mean, somebody was saying you could split his career into 3, and each of the 3 would be a Hall of Fame career.
Yeah, it's remarkable, right? Now that he's in the Super Bowl, he will be in 19% of all Super Bowls ever played, or something
insane. Like that. It's just absolutely insane.
Yeah.
So you've caught this whole Boston sports ride until, well, I guess this last year hasn't been very good. Lost Brady, lost Mookie. That's not a very good.
Lost to Dana Chara. Yeah, we lost Kyrie Irving, but I don't think that was a big loss to us.
That still yet to be played out.
It is. But yeah, we had a good run. I mean, going back to the, I guess,
Crazy.
Red Sox in 2004, and the Bruins had a championship. The Celtics had a championship.
It's absolutely crazy. Bostonians have nothing to complain about. I unfortunately have the disgrace of burden. I've been a lifelong Cowboys fan. Oh. So it's been a long while. And the weirdest thing is, I come into a group of all sorts of circle. I've never told you this story, is that a client of mine out of the Dallas area, we were commiserating, and it comes out she's the close friend of Too Tall Jones.
Oh, really?
So I thought you were the coolest of all of my contacts, Bob, but sorry.
Yeah, I will gladly cede that position. That's great. But of course, those were the glory days, right?
Yeah, those are the glory days. Absolutely. Long gone, unfortunately. So we thought that 2021 was, at least it's not 2020, but it's not really started out.
No, I feel like we're running in place a little bit, but maybe we're making a little forward progress.
Are you getting much, over this past week? You're sitting in a spot where you're largely working on retirement topics. But even then, you can't be completely blind, and, every podcast and YouTube video on the planet, doesn't matter what the topic is calling up GameStop. So what do you make of this whole thing as far as, from your perspective, as far as, are you getting questions and things like that?
Yeah, we're getting questions. One of the features that we run in Retirement Daily is something called Ask the Hammer, where I talk with Jeffrey Levine from Buckingham Wealth Partners. And a reader question came in about GameStop and whether they should buy it and what's a short squeeze. So there's definitely it's really raised. I mean, I think it was there prior to GameStop, right? I look at I call it the Robin Hood generation. These are like I have children ages 25 and 22, and
right.
They all have Robin Hood accounts, and they're always buying a share of this and 2 shares of that, and asking me what I think about this. And they were late to the party on GameStop. I must admit, they called me after it had risen by a lot to wonder what was going on. And I think what's interesting about it is, right, this is a case of, I mean, certainly like people are calling it the David and Goliath kind of story. And in a way, it is that. But it's also a story that I don't think ends well for most of the people who bought GameStop. Now, it's not over yet,
right.
But I think what happens is this stock is grossly overvalued at this point relative to sales and earnings and whatnot. And I don't see what the play is here. And so when it starts to fall, and it will, and people start rushing for the exit door, well, only one person can get through that door at a time. And that's going to leave a lot of people wishing that they had sold a day prior when this thing starts to plummet. And
when the music stops, it's going to be interesting to see, because we've got all this uproar about, Robin Hood shouldn't be restricting, access to certain shares of certain companies, et cetera, and they closed it down and they turned it back on. And it's going to be the uproar on the other end when, hopefully private investors don't get too hurt, but there's a buyer when someone was selling, at 300 something. And
right. And that buyer was a hedge fund that had to cover its position. On the way down, there may not be anyone there on the other side. And so it may fall a lot. And I look at this, it's an interesting story, because I think if you say, okay, as a investment strategy, buying stocks in companies where there's a high short interest is an interesting play. And now we've witnessed the power of a Reddit platform, of an army of people who buy into a storyline, whether it's AMC or Nokia or, name the stock.
BlackBerry.
Right. And all of a sudden it creates this stampede. And then it's a movement, right? I mean, people kept saying, resist the hedge funds, keep buying, right? But without any basis for buying it. I mean, right? This would, if you were a fan of Warren Buffett, you would be horrified. If you were a fan of, of Graham and Dodd, you'd be horrified by this. It's not anything I would ever advocate for. That's for sure. I mean, investing in short interest stocks, sure, but this kind of fever, not so much.
And investing in short interest stocks is not anything new, right? I mean, and I think I saw some research the other day that, the Russell, has largely been driven by a very small subset of shares that, had, not coincidentally huge short interest. And, that has, outperformed, NASDAQ and S&P 500 over the past quarter, certainly, by pretty notable difference. I mean, meaningful difference, so it's going to be interesting. The other thing I was thinking, have you been looking at Wall Street Bets, which is the Reddit the platform and things like that? For me, what struck me is that, the conversations that I see on these Reddit platforms, because people are going in there without their full name, that some of the information and some of the posts, rather than just the normal cheerleading and, diamond hands or whatever, slogans that people are using, that is the data and jargon and information not used by everyday people. In other words, that is someone with an options book or options information, right? I mean, people now know what gamma hedging is, and things like that.
Yeah.
But some of the other posts that I've noticed on these sites are not actually, there's no way they could have invented that language. You see what I'm saying? In other words, somebody in there is in fact a professional who's actually in there, contributing.
Yeah, well,
for better or for worse.
There was I don't know if you saw it, Jay. There was a great story in the Wall Street Journal over the weekend about the guy who is credited with creating the GameStop frenzy, and he's a fairly young guy who has a CFA, a Chartered Financial Analyst designation,
right?
And has been doing this kind of, and he had worked up until recently at Mass Mutual, a financial services company, and he has a YouTube channel, and I would describe him as a serious investor. He knew what he was doing. And you're right. I think there are other people in there that do know what they're doing. And, I wonder about the degree to which, I mean, like if you worked at a mutual fund company or even an investment newsletter, right, you can't front run a stock, right, that you own. But that's seemingly what is occurring to me here too, is that we've got a lot of front running going on, right, where people own the stock and then start touting it. Now, I'm willing to bet that the SEC can't prosecute anyone or maybe they can. I don't know. It's going to be.
I don't know.
Plays out.
It's an interesting thing, and it's peculiar because you see in the media, on TV, et cetera, and I'm not sure how. Maybe you can give me some insight. The average person watching the TV clip may or may not understand the fact that the mutual fund manager or whatever investment strategy point person, is talking about, their own internal position, and there, though, that they know that they're regulated. You see what I'm saying? I mean, they know, the light turns on. They don't just get to start, blabbering away.
Yeah.
And yet here on these Reddit boards,
Jay, was like people are posting their account statements, right, which I find really fascinating. So, on the one hand, okay, maybe it's real. Two, it's a paper profit at the moment, right? It's only a profit really until you sell it. So, I'd be curious to see what their account statements look like after they sell it. That's one. And two, not that you want to say this is a reason or not to get involved in this sort of thing, but the the taxes on a short-term capital gain like that will be not insignificant.
Oh, it's going to be big, and whether or not everyone knows exactly how much that is and how it gets calculated and that kind of thing is a whole different thing where, the ripple effects are not known. I think it'll be interesting to see because on one hand, you've got this movement where you've got, Main Street versus Wall Street, but yet Main Street through their 401k, their IRA, et cetera, that if the short sellers are covering, and then they can just cover just by buying back. The other way is, they could just post the collateral. But in order to post the collateral, they'll be selling the winners. And in order selling the winners means selling Apple, and not Apple specifically.
Right.
But you're just talking about ones which have, the NASDAQ, which has, been on a tremendous run, on a multi-year run here. So now, did everybody actually understand that that's the ripple effect that could, if it continues to leak into other, they think, oh, well, I'm immune from GameStop or the whole dynamic. Maybe, right? Unless it gets too big, it's fine in some little corner of the universe where someone's short covering some $400 million company and that's it. And that it's just the isolated incident. But you're talking about a bigger scale. Now you're talking about leaking into the big indexes that everyone's allocating, large amounts of capital. That will be interesting to see. And I don't think we know yet.
Yeah. And I think, we have a way of forgetting history, right? We have it in 2008, right? AIG and CMOs, right? And long-term capital, right? I mean, we have a history of forgetting how the ripple effects, right? The butterfly effect can take flight in ways that we can't anticipate. So I don't know, this story's not over, I don't think, by any stretch, right? Like, as you said, as people they have to sell positions to cover their losses.
And it's interesting because you exactly pointed out what I tell other persons in my financial planning process, which is that, you can hedge, you can get away from a single issue. But when correlations break down, what you presumed were uncorrelated, all of a sudden, snap and everything goes together in one direction. Now you've got a problem that can turn into calamity. And that's, the housing crisis, CMOs were, the, mortgage-backed securities were not nearly as uncorrelated as, the rating agencies and the modeling and thus, the Big Short, et cetera, would have suggested. And so now, whether or not that same risk comes to this as a result of what looks like a single issue about GameStop or, AMC, et cetera. So I'm not sure. It'll be very interesting to see.
Yeah, the story's not over. And I think, it's not the same story, but Bitcoin is a little bit the same too, right? Where we have this frenzy around an asset whose value is really hard to ascertain. I think I'm still, it's a puzzler to me, why it's worth so much, other than the madness of crowds.
That for me is slightly different because there are other technical reasons, right? I mean, there's the store of value, there's payment processing, non-government fiat. But then again, then you've got whole extra risks. I mean, I have made comments on this, privately. What's to stop a government from saying, okay, this is outlawed and we're now creating our own digital currency, period. I mean, and then you'd have a whole different, regime. And I don't know what, if the cryptos, how they will deal with that or what the price what would happen.
My biggest problem, I think, with crypto at the moment is that, it's not necessarily it's currency in the sense that you can use it to buy and sell stuff, but it's not currency in the sense that it has the same value today as it did yesterday or tomorrow, right? I mean, yes, the dollar fluctuates against the euro, against the yen and whatnot. But the kind of swings that we see with Bitcoin don't exist. And so for me, it's really hard to think I'm going to buy a car or I'm going to the grocery store. I'm going to use my Bitcoin. And when I walk into the store, it's worth X. And when I walk out to the cash register, it's 20% less than it was when I walked in. And I don't know how you can create a currency around something that has that kind of volatility.
And I saw this. I had this thought as well as, you've seen these headlines where companies are putting their retained earnings, their cash balances into crypto in, big numbers. So how are you going to value these companies? I mean, one of their assets is going to be, here's my cash balance. I mean, right now, we look at Apple and we know that they have this amount of money and they can cover their debt, by 6 trillion times. Well, what happens when their reserve on that reported number on some earnings number all of a sudden is subject to 20% a year volatility? That's a foreign exchange risk, that they currently face, but not to that volatility. It's going to be how are you going to value the companies?
Right. And then add to it the sort of the taxes that come with Bitcoin, right? It's considered a property, so it's going to be right have capital gains and capital losses, and so there's the added complexity of figuring out, especially at the individual investor level. I think,
Right. For sure. For sure.
That much, because it's not like earning interest income on a bank CD.
So that's enough of current events talk.
Fair enough.
So, a little clumsily as far as segue, tell me about the street.com. So the Retirement Daily is fairly new, relatively speaking, not your work, but what you're doing at the street.com.
Yeah, it's new, but it continues something I began in 2003 at MarketWatch, where we had launched a subscription newsletter called Retirement Weekly.
Okay.
And at the time, in retrospect, thankfully, it was only published on Friday afternoons. And along the way, what happened was the person who recruited me into MarketWatch was a very dear old friend who I worked with back in the late 80s, early 90s, a gentleman named Dave Calloway. He and I co-wrote a column together at Boston Herald in the late 80s, early 90s. And then fast forward to the 2000s, he was then editor-in-chief of MarketWatch. And he asked if I would come over and start a newsletter that would focus on retirement. And thus Retirement Weekly was born. And then fast forward a decade plus, and he becomes the editor-in-chief of USA Today, and he recruited me to write about retirement for USA Today, which I started doing. And then fast forward a few years from there, he became the CEO of The Street, and he recruited me to start writing about retirement for The Street and to launch another subscription newsletter, which we dutifully had to rename something other than Retirement Weekly. So we called it Retirement Daily. And we launched it in, I think it was April of 2018, if memory serves. And now we publish daily. And the interesting thing along the way is Dave is no longer CEO of The Street. He's moved on. The company was bought by a company. The Street was bought by a company called The Maven, which also owns Sports Illustrated. And the Maven has a different business model. And one of the things that they did was that we produced Retirement Daily. We switched it over from a subscription-only newsletter to a newsletter that has content in front of a paywall and also content behind a paywall. So we're publishing today in the new format about 10 to 11 articles per week. About 5 of them written by professional financial advisors, half of them written by me. Some of them are videos where I interview. I mentioned Jeffrey Levine. You and I do videos about Medicare and healthcare related topics. We take questions from readers. We have a feature called Ask Bob. We published every so often a curation of all the retirement related research that I've found on the internet, published by places like Wharton or Boston College or Michigan. They have a retirement research center there at the University of Michigan. And it's been great. I think one of the things that we pride ourselves on is the fact that we're putting on display the knowledge of financial planners about topics like Roth IRA conversions or Medicare or Social Security. And I think we're filling an unmet need out there, which is interesting because when I think back to 2003, when we launched Retirement Weekly, one of the premise was that there were 77 million people marching toward retirement, and none of whom necessarily knew where to turn to for good guidance and education and knowledge and wisdom. And so we didn't have to capture all 77 million of those people, but we just get a small fraction of those folks in terms of readership, and that's how it began. And what's interesting is one of the things that happens is I like to refer to it as just-in-time learning. So every year, 3 to 5 million people turn 65. Right. They go on Medicare, right. And those 3 to 5 million people didn't think about Medicare or Social Security 10 years ago. But in the moment that they do have to think about it, they consume as much information about it as they can possibly get. So every year, I kind of get a new batch of 3 to 5 million people who are interested in, at least specifically Medicare and Social Security. IRAs are constant, Roth IRAs are constant, 401ks are constant. But each and every year, there's a new sort of group of 3 to 5 million people who do a deep dive on the thing that they need to know before they claim Social Security or apply for Medicare.
Well, it's funny you were saying that, that the 70 million people, and you don't need to capture them all. Crazy people write books about, on on the same, on a very, very, that premise sounded very, very familiar somehow.
You're not calling yourself crazy, are you?
Well, it's been, exactly what you had said. And I think we are probably, in agreement, probably why we're able to, continue on with each other, so regularly, right? We know that people have put it on the back shelf or, back burner, et cetera, et cetera. They know that there's something. And, they're, next to our saying here, that's why I also have the little statue there, because, that's the elephant in the room. Right. So,
Yeah,
which is, you have got these topics that people don't know about. They kind of have heard the lingo, maybe, or, well, now on Medicare, they turn on the TV for 5 minutes and you get a commercial and stuff like that, but certainly into your site. And so years ago, the baby boomers weren't yet here. How did Bob Powell get involved in, this is even before, like you said, you were talking about a long time ago at the Boston Herald. This has been kind of your niche. How did you get to that niche?
all right. So I'm going to try and make the story short as possible.
Right.
So I don't want to. What's the Steve Martin routine? I was born a no.
Right.
So actually, it begins in some ways around 1984. I
Wow.
graduated college. And my first job out of college was I was working for a pharmaceutical company. And after 4 years of doing that, I decided that I wanted to change careers. It was a great career, but my options were kind of unappealing, shall I say. So I read the book, What Color is Your Parachute? At the time. Right. And I completed all the exercises in the back. I'm probably the only person in the world that's ever completed all those exercises. And at the end of those exercises, the two options for me were become a journalist, because I had been writing by night for the 4 years I was in pharmaceutical sales.
Okay.
Or become a stockbroker. And so I investigated both those options, very different options, as you might imagine, right? Sure. And one of the things I learned along the way was that journalists were not very well paid, and stockbrokers were. Okay. So I thought, okay, I'm going to become a stockbroker. And I did. I went to work for Dean Witter Reynolds in 1984, from 1984 to 86. And I was part of what has been described as the Dean Witter Reynolds experiment, or the Sears experiment. Right. Sears, right. Sears owned Dean Witter. They owned Allstate. They owned Coldwell Banker. I was in an all-rookie office in White Plains, New York. And once a week, we had to go to the Sears store in Stamford, Connecticut, in the basement next to Allstate and Coldwell Banker, with a little green banker's lamp on my desk and a little chart showing what the Ginnie Mae rate was that day and what the CD rates were and whatnot. And I tried to be successful as a stockbroker for 2 years. I did a variety of things. I tried to sell the company's asset management to pension plans in like Westchester County and Fairfield County. I tried to sell bankers' acceptance notes to the Treasury departments of Fortune 500 companies by day. And then by night, I would cold call using the Kohl's directory, trying to get folks in Darien and Greenwich and whatnot to buy municipal bonds or buy IBM stock or whatever. And the truth of the matter is, I'll give you two stories about how bad I was at this.
Is anyone really good at calling on the telemarketing?
I don't know. It's an interesting. So two stories. One is, I'd be calling someone in Fairfield County, and I'd have the analyst report that said IBM was a buy. IBM was, as you may recall, is headquartered in Westchester County in New York. Right. So there were a lot of IBM folks around, and a lot of people who cared about IBM. And I'd call and say, "Oh, our analyst Joe Smith has a buy recommendation on IBM. Would you like to buy 500 shares, or is it 100 enough?" And the people would say, "Yeah, that's great. There's a buy. Are you sure it's going to go up?" And I'd be like, "Well, it beats the heck out of me, sir. It's a stock. It could easily fall in value. It's right. It's a risky asset." Right. What do you want from me? I'm not I can't read.
You don't have a crystal ball?
I don't have a crystal ball. So, of course, that didn't make help things that I couldn't tell, just one side of the story.
Right.
And then the other is, this is my favorite story about being a failed stockbroker, is that I was in the Sears store one day and a gentleman came in late in the evening, and he had just sold his house. He was in his 60s or so, and he had come into the most money he had ever had in his entire life, and he wanted to know what to do with it. So I spent the next hour or two explaining to him the investment pyramid and safety of principal and liquidity and risky stuff. And we talked about everything from money markets all the way to, well, at the time, if we had Bitcoin, I probably would have talked about Bitcoin.
Right.
And then all of a sudden, the lights go out in the Sears store. There's complete darkness except for my green banker's lamp. Right. And he and I, because the door was closed in our little office, we never heard the announcement that the store was closing. And we were, in effect, locked in the Sears store. Oh. Him and I. Right? So we had to call the Stamford Police Department, which then called the manager of the Sears store to come down and unlock the door. And, the next day I'm telling my branch manager this story, and he wants to know how it turned out that I closed the sale. No. I mean, if you can't close a sale when you're locked in a store with someone, right?
Talk about a captive audience.
Right? And I said, after we got done, he said he was going to, he really appreciated all I had to say, and that he was going to take his money to the bank where he had his, savings and checking account and just leave it there. So I never made the sale. And, that was it, huh? That was it. That was sort of, now the interesting thing was, by day I was doing stockbrokering. By night I was starting to fulfill my desire to write, and I started writing. I wrote for Connecticut Magazine. I wrote for the Westchester Business Journal. I started, enjoying writing, and I started enjoying writing about money, which is sort of like how it came to pass. That and I thought these are my two loves. I love the market and I love writing. And so in 1986, I pivoted. I went back to grad school. I got a master's degree in journalism. And then I began the long, slow climb up the journalism ladder. I worked for the Berkshire Eagle, the Boston Business Journal, the Boston Herald. I went to a company called Dalbar, where I was the editor and publisher of a stable of trade publications in the mutual fund and annuity industry. And then from there, it was the year 2000. And as you may recall, 2000 was one of those great years in the market, right? Money was flowing in, right. Companies were being launched, right. Venture capital companies throwing money around. So I left the company where I was as editor and publisher of the trades to launch an online education company. And we were successful for 3 years. We went through several rounds of financing. We launched the Boston University online CFP program, which I'm still very proud of. It's still in existence. And but along the way, as each new venture capital company injected money, what we found was that the founders, myself included, were being sort of shoved aside. Right? I see. It was, and then one day, it was a little bit of out with the old and in with the new. And one of the interesting things was the last round of money that came in. The folks were like, this is great that you've built this product, but you haven't sold it. And we said to them, well, we have a marketing plan. We just need money to execute the sales and marketing plan. And the reason we don't have sales is because we spent all our money building out a really good product. And, you might say that was foolhardy, but we now have a product that a product that people want to buy. We just now need to execute the marketing plan. Anyway, and they said, okay, well, we'll do that. And thanks for building out the product. And they let go of like almost everyone who founded the company, except for a couple people. So in 2003, I was on the outside looking in without a plan B. And that's how I came to pass that Dave Calloway and I reunited. That I see. Market Watch. And he said, you've been writing about money and personal finance. And he said, what do you think is next? And I said, well, Ken Dykewald says that baby boomers are the biggest market in the world, and we ought to be writing about retirement for them. So I credit Ken Dykewald too for being the inspiration for me pursuing retirement almost exclusively.
And at this point, what's next? I mean, you're going to keep building out Retirement Daily. Well, and also you were kind of fortunate, right? I mean, you never know, right? Because obviously the local newspaper, etc., doesn't have resources at this point. With the newspapers, are there any even big city newspapers are not in good condition at all, really.
Yeah.
So, and now you're here in the digital world, so you've kind of one half step ahead.
Yeah, and it's interesting. I don't know what the next step is. Retirement Daily is a good platform. It allows me to do lots of things that I couldn't do on my own. I'm able to produce videos. I'm able to produce podcasts. I think one of the things I want to do is create a library of retirement webinars, where we have a just a complete and have it be a complete library of educational webinars about all things retirement. So I think that's one. The other is I and actually my former colleague from my days at the online education company going back to the year 2000. He left and went on to found and several companies that he has sold to various entities like the Washington Post and Google and Microsoft and on and on. He's become a serial entrepreneur. He came to me a year ago to launch something called finstream.tv. And the thought is, I think if you say what's next is everyone's in love with streaming right now. Yeah. Right. And he said, I think we could create a streaming channel focused on personal finance and to have a channel that offers everything to everyone, from whether you're Gen Z or the silent generation, whether you're just graduating from college, or you're at the tail end of caregiving or needing care, or whatever your topic might be, whether you're, male, female, black, brown, young, old. And so we've been slowly over the past, I'd say 6 to 8 months, posting videos onto finstream.tv. We're now on Roku and Fire TV. And
how does that even work? I mean, how do you access that?
So if you were to go on to Roku and search for Finstream TV, you would find, several long form and short form videos that we've produced so far. And our hope now is we're in the market looking for sponsors for our content. And what we're aiming to do is to sort of build our business on 3 core principles. One is create original content. 2, curate good content. We know that there's a lot of folks out there, building content, yourself included, where we can curate that content and
my content's bad, Bob. I mean, I got this face, I've got this horrible Midwest mumbling. So,
well, I'm not I'm hardly a pro at this, but as you've seen, lots of people have been successful on video.
That's fair enough.
Chet and Dave, right? So that's so there's original content, curated content, and then sponsored content. There's a number of entities that commercial entities, academic entities that are publishing good content as well. So it's been I do that in addition to everything else I'm doing, and at some point, maybe it's the only thing I do. Though I have to say, I'm the kind of person. I don't know if you've ever done a Colby assessment of yourself, but anyway, it's an assessment that sort of says what you're good at doing and how you do things, and I like launching things. If I had to sort of say what's the one thing that really gets me up in the morning is launching things and getting things up and going and trying new things. And so this to me is exciting. I don't know if it'll be the only thing I do once it gets up and running, because I also like variety. I like being able to work for different people and work. And I'm at this stage of life, and I don't know if this is true for you, but I feel like I'm old enough where I really just want to work with people I like working with and on things I like working on.
I'm always afraid of those self-assessment things. I'm afraid the result will be like, you're no good at anything. Or like, that's why I need to take Myers-Briggs and stuff like that. And I was like, and then you read the 4-letter combinations, like, this is like some scary, horrible person. Like, what are you like?
Yeah,
maybe changed my answers along the way with that in mind.
I know. It was odd. I guess the Colby in some ways confirmed what I already knew about myself. So,
and that's the other thing, right? Is aren't people like gaming it? So like, okay, well, I wanted to say this about myself, so I'm going to answer it in something in this way.
Yeah, I don't know. But it is true that I like launching things, and it's funny when I worked at Dalbar. I've had two big influences in my life that I want to share with you, Jay. One is when I first started out of college, I worked at Marion Labs, which was founded by Ewing Marion Kaufman. And I don't know if that name rings a bell or not, but
I've heard the name.
yeah. So today there's the Kaufman Center for Entrepreneurship in Kansas City, Missouri. Ewing Marion Kaufman had also owned the Kansas City Royals as well as Marion Laboratories. He was, to my way of thinking, one of the greatest entrepreneurs I've ever had the luxury of working for. And I learned, I mean, not that I worked directly under him, but just the philosophy that imbued the company was you couldn't miss it. And to this day, I'm thankful that that was like my first job out of college, because you really got a sense of how someone could build a company, make everyone involved in its success, everyone care in its success, everyone share in the wealth of its success. It was really remarkable. You know, in fact, Marion Laboratories, prior to Microsoft, had produced the most millionaire employees of any company in the history of the United States.
Hmm.
And had I stayed, I probably would have retired at age 30. You know, it was that lucrative. And my father always yelled at me for leaving the company. He called me a damn fool, I think, for you know, exiting the company. But you couldn't have paid me any amount of money to not to do something I didn't quite enjoy at some point. The other entrepreneur I worked for was a guy named Lou Harvey, who ran Dalbar, which was the mutual fund research and publishing company that I worked for from 1993 to 2000. And Lou was a classic entrepreneur, very different company, maybe 10 million in sales, 70 or so employees. But Lou sort of worked a little bit like Ewing Marion Kaufman in some ways not. Lou was always the kind of guy that would say, whatever rules are in place are subject to be broken. and then he would say things like, whatever I said yesterday was true yesterday, but might not be true today. And so you had to operate in this atmosphere of chaos in a way, because he was always sort of trying to, he was always trying to do one of two things: either meet the needs of the market, which he was very good at, or anticipate the needs of the market, which he was also good at, but the success rate there was much less, because you just had to, you didn't always know, right? And I was always the person who had to execute the one out of the, you know, try to figure out which of the 10 things that anticipated the future might work. And that was fun for me, because I got to sort of like be at the cutting edge of what we were doing and what the market, you know, trying to lead the market to a place we thought it was going to go.
Oh, absolutely. You know, one of the phrases I like to say is, you know, there's creativity out of the chaos. Absolutely.
Yeah, and he was great at that. I mean, we had, truth be told, we had high turnover because not everyone can work in an environment.
Oh, sure,
like that.
sure, right. Not everyone is built that way to get the creativity going from
Right.
you know, they just see the chaos.
You're right, and I thrived in that environment because I thought it was exciting to sort of just see what's next. You know, and that's sort of like what the news business is. The news business is like, what's next? All right. You walk in the old days, you'd walk into a newsroom not knowing what you were going to write about that day necessarily.
At your place, or if you're sitting on an umbrella, you know, people go to Retirement Daily, but they're going to thestreet.com and getting some persons from there. So does that mean you're interacting with the rest of the way the entire platform works, or it's just kind of you standalone, you're the captain of a ship in a fleet?
So I get to be the captain of Retirement Daily. And then when it comes to the street proper, I work with an editor, and we're posting retirement stories and personal finance and investing stories there. You know, the interesting thing about the street is it's largely driven by, you know, it's largely driven by Jim Cramer, right? I mean, he founded the company. Right. And much of it is around investing, and much of it is around, I think, real-time investing opportunities. And which is interesting, you know, from my perspective. People might come to the street to get that kind of real-time investing news, and then they stay for retirement, right? Because one of the things that happens is everyone loves the thrill of investing, but you're investing for a purpose, and oftentimes the purpose of investing is to build a nest egg for retirement. So it's a great match in many respects, because the investing draws people in and the retirement content keeps them there.
It's going to be interesting to see, because, and I think part of this Reddit, you know, if we go back to the GameStop, et cetera, is that, and you had mentioned your children, which is, people like us, we wouldn't necessarily build financial literacy matters or financial fluency matters, I don't think have done a very good job of reaching out to, the 30-year-olds of the world, right? The stuff isn't appealing, et cetera, or, unless they're pulled in by force, some other meaning, something has, required them to do so. But to get them up to speed, it'll be interesting to see whether or not, this saga, the fact of, Robin Hood and, younger generations, involved in financial markets, and whether or not that leaks into other financial topics, or if it just kind of stays over there as some kind of, glorified buy low, sell high, hopefully exercise. And that,
So I'll share this with you. One of the things I got to do at Retirement Daily, I mentioned experiment. So I forged a relationship with the Financial Planning Association. They have a next gen community, a community of age 40 and younger financial planners. And there's 2,500 of them in the organization. And we created a relationship where I now have these folks, these under 40-year-old financial planners, starting to write about non-retirement related issues for that audience. So on Retirement Daily, we know that a full 50% of our readership is under age 55, and about 1 in 5 is 25 to 34. And
that's a lot higher than I would have thought.
It really is. It was a surprise to me.
That is very surprising.
For like how to invest my 401k. And so my philosophy now has been, okay, you came for retirement. Let's give you other stuff. So I have these financial planners writing for me now from FPA Next Gen. Haley Talitsky is one of them. CJ Miller's another. And there's 18 others that are in the stable who are writing right now. How do I buy my first home? How do I buy an engagement ring? How do I create a budget? So we're now creating personal finance content aimed at, I'll call it, I call them next geners, but they're really Gen Z and young millennials. And we're getting some traction there. People seem to, we're getting page views. So for me, the experiment is starting to work, that people do want to know. Again, so much of it, I think, Jay, is also just in time, right? I'm buying my first home. What are some mistakes I need to avoid? Or I'm getting engaged. How do I go about doing that? Or, I use Mint, but I really don't know what the heck I'm doing with it or something.
Right.
So I think I'm hoping that we'll tap into this growing need on the part of, it's interesting. I mentioned my children, they're 25, 22. We did a piece on what are the elements of your credit score and how can you improve it? And I have to say that before I even did the piece, I was talking to my kids about this. They knew more about credit scores at age 25 than I ever did,
Really?
Even at age 45, right? Because of YouTube, right? They've been able to go out and figure out, length of credit history, payments, right? Whether you have, how many cards you have and when was the last time you applied, all that stuff. They knew all of it.
They knew how it worked.
Right. And they said to me, I can't get my credit score any higher until I've had a longer credit history. And so I kind of scratched my head thinking, wow, they didn't come to me for that. They didn't come to me to learn how to tie a bow tie either, but that's okay. But they went and found the information that they needed to improve their credit score. And you had to applaud them because, they could have easily gone through life not knowing that.
That's actually an interesting fact and a surprising one. But yet, after you've described it, the information's out there if it's kind of, curated and put into a place where someone can access it. And it's excellent point about the fact that it's, just in time, on demand, that type of thing. So.
Yeah, in fact, one of the things, I don't like doing live webinars because I think it's really hard to schedule people to come to.
Right, I totally agree.
Right? Yep. I just assume record it and post it and let people come watch it when they can. So
absolutely. Well, Bob, I've enjoyed this. And before we get, before we go to a second hour, et cetera, we can talk about so many other topics. But again, it's thestreet.com Retirement Daily. There'll be a link in the podcast as well as video form, et cetera. Bob, it's been great to work and talk with you. We've always talked about, our little interview questions or exchanged emails about the quote that you'll use, in your articles. And thank you so much for your support of the book and things like of Maximize Your Medicare. But, I've enjoyed today.
Thank you, Jay. I've enjoyed it too, and I think I've exhausted all my stories.
Okay. Thanks, Bob, and we will talk again soon and look forward to working with you, on an ongoing basis.